All right, are you ready?
I'm ready.
All right. Well, welcome to Wealth Without Borders, where we discuss money and limitations and how we break through over off that side. So ultimately, Scott, how you been?
I've been pretty good.
Good.
Yeah.
Good.
I'm enjoying the weather. I hope I don't bring this up too much, but going for bike rides and hitting golf balls after work a little bit. So hey.
So I actually am very excited because this is like the first time of the year, at least here recently, we had another campfire, but I didn't have to force it. So we've been doing them, I think, since August, and everybody's been like sitting 10, 15, 20 feet back from the campfire because it's been too hot. And like we finally had like the perfect evening that we were able to sit around,
where it's a little
watch
bit cooler.
the fire,
Yeah.
have the legs out in front warmed up and all that kind of thing. And I told my wife, I was like, well, I didn't have to force this one. Now, I will say that as one of the other items on that, though, we also do that because it's less dishes. The dishes are actually a lot easier every time we do that. So, and not heating up the house as far as the oven and all that kind of stuff. So I guess there are some other advantages. It just makes it a little bit more unbearable when I'm roasting a marshmallow. But it was really awesome here just recently.
Well, marshmallows. So what else are you doing so you
just
can
like,
avoid?
It's like hots and
hot
it's
dogs.
like hot
Okay.
dogs and brats and but it's not like even real brats. It's like the glorified hot dog brats.
Okay.
So, things are going really well. Yeah, a couple other things I wanted to mention here. So, if you're in the local Cedar Rapids area, we do actually have a couple of seminars that we're going to be doing. So, these are actually going to be taught by myself and then also Elias Randall, one of the other advisors here in the office. October 17th, that one is titled Surviving Market Uncertainty: How to Invest with Confidence During an Election Year and Beyond. A little bit relevant, given all the constant chaos that seems to continue to happen. What's kind of interesting on that is, as I'm sure we have discussed and will discuss, it's nothing new. So we will go through as far as how we want to make sure that we look over through the lens of a financial planning mechanism in order to accommodate for all these things that are under constant chaos. And then on November 7th, a topic near and dear to my heart, again at 5:30, and it is estate planning basics. So tips, tricks, and tools to help you understand your options when it comes to estate planning. And this is, I'm quite excited about that one because I do particularly enjoy that topic. So we do have some things that are going to be happening here coming up.
Okay. Sounds good.
All right. So with that, let's go ahead and get started on some of our topics. So topics of this week, we're going to be spending a lot of time talking about retirement plans, talking about 401ks in particular. Now, I would say that keep in mind that when we say 401k, we're talking about a specific retirement plan type underneath Section 401k of the tax code. A lot of this information can be applicable to things like 403b accounts or 401a accounts. There's some nuances on that side, so it may not necessarily match one for one. For example, there might be different contribution limits. There might be some different access limits depending on the overall structure. But by and large, we'll kind of mean 401ks and talk about that because that's what the vast majority of people, when we sit down and talk to them in terms of retirement planning that are making contributions to a workplace plan, that's what they're using. So that's kind of the primary topic. So for the first thing I want to mention is something we call it the $1 billion 401k blind spot. Now, $1 billion is not an insignificant amount of money, and just a little bit of information. We've got about 5.7 million people have taken money out of their 401ks and put that into, about $618 billion went into individual retirement accounts or individual retirement arrangements in 2020, just according to IRS data. Okay, so the IRS actually receives a document anytime money is exiting out of some of these plans. There's a 5498 that actually gets sent over to the IRS, basically tracking these transactions, or excuse me, a 1099 that actually goes to the IRS tracking these transactions, and then a 5498 would be issued by the receiving firm showing that those funds had arrived. So, about $618 billion got transferred according to the 2020 IRS data. Now, when you move money from a 401k plan, and oftentimes what we see happening is there's usually one or two different ways that people have access to that. Either they've selected some individual investments, or they're utilizing something called a qualified default investment allocation, or a QDIA. Typically, these are things like target date funds. Now, I could go have a whole other show about how much I don't like those. But ultimately, they're designed to make sure that people inside of these 401ks, inside of these accumulation vehicles, really are investing in things that are likely to give them growth over time. What most people don't realize, or about 2/3 of some of the data they were looking at in this thing, when you move that money from that 401k, unplug it from that investment allocation and put it into the IRA, you're not done. You still have to actively go in and make sure that those investments are actually allocated rather than just sitting in cash. So when the money moves from the plan over to the IRA, generally speaking, unless we're utilizing like an NUA strategy or something like that, it's going to come out as cash and get deposited as cash. So it gets sold and then deposited as cash. And unless you go in and actively trade that or make an election inside the IRA account, you're sitting in a cash account. And so there's a lot of people that may think they're still investing in things like, in stocks like at the S&P 500, or maybe an international index like the FTSE 100 or something along those lines, but they're not. They move the money. It's not going into exactly the same stuff. So I just out of curiosity, I mean, how often have you seen where maybe somebody that you met with has done this before in the past, or have you ever seen it where you take a look at maybe something they've done and it just wasn't allocated? Is that something that you've run across?
I think I've run across it all too often. Actually.
Well, one time is probably more often than you'd like to see, right?
Yeah, and most of the time the participants, I mean, really are. Yeah. Oblivious to what had happened to the account and stuff like that. So, and that kind of leads into some of the mistakes that people make. When they do leave the employer. First is they look at the account balances. Maybe it's just too small, and it's not going to get me anywhere. Whether it's $1,000 or what have you, and they just take the cash. Pay the taxes and the penalty on that distribution, and really they just kind of rob their retirement. And if you would have taken the efforts, and maybe $1,000 isn't that much money, but over time, and it happens a couple of times in your lifetime or careers, it can definitely add up. I mean, how many times have we looked at what does $1,000 investment turn into over a 40-year period of time, which we do see that a lot.
Yep. Well, and kind of along with that too, I mean, even sometimes from a mistake standpoint, that may not necessarily be elected by the individual. So oftentimes in a lot of the 401k design conversations that I've had with employers, we can actually make some elections where if there's certain low account balances, because there is a cost to maintain that at the employer standpoint, they may force those out. So usually if it's less than $1,000, if you don't make some sort of an action within a certain time frame, they might send you a check while also doing the 20% mandatory federal withholding, right? Or if it's underneath, usually the threshold that I've seen in there is if it's underneath $5,000. I've seen instances where people have been forced over into an IRA. And to kind of bring that back over to that mistake that we've seen, guess where it goes? It's usually going directly over into a cash account. So exactly to your point, if that happens, so maybe I don't have it come out to me directly, but that actually does occur, and then it gets put over into that cash account where I'm not seeing that yield, or growing over that period of time. Maybe that's not something that I actually elected, right? And I didn't know that it was happening. It's just one of those things that the employer, in their wonderful design and them trying to be administratively efficient and effective as well, basically made that election for me when they did that plan design itself.
Right. Yep. And I mean, that leads into my second topic as far as the mistake goes, is losing track of your old 401ks. Because like we just talked about, you don't necessarily know what is happening to that account if you're not paying attention to it on a regular basis.
Yeah, I'm kind of looking at this, and this is kind of staggering, that 2015 number. Americans lost track of more than $7.7 billion worth of retirement savings. Accidentally and unknowingly. I mean, yeah, maybe as an individual, maybe a single individual that might not necessarily impact, but I mean that is substantial in terms of the overall amount of dollars that just get are kind of floating out there that maybe don't necessarily have a that are just sitting out there. And I mean, that's coming from, the National Association of Unclaimed Property Administrators. So, one of the things that, and again, this gets back over to some of the estate planning type things, right? But I don't care who it is. We want to make sure that we are checking the unclaimed property databases for individuals if they pass away, because there is a possibility there's some retirement plan that's been sitting out there that maybe they did not know about. Now, I also think that's important for individuals too, right? Every state has some sort of a database that will actually have that if this, that actually does get turned over to the state basically for administration, or at least notice and some things like that where it goes to a database. So plugging your information on there might actually allow you to find and reclaim some of this. Again, $7.7 billion in 2015.
Yeah. Do you think if I went out there, I could claim that $7.7 billion?
I think you better go double check your name. And I think I know what you're doing after this podcast.
Exactly. I've probably checked it already, but that's a staggering figure, really, in my opinion. So. So on the next step, I mean, so now you find some unclaimed, and so now what do you do with it? It's sitting somewhere in an IRA and cash and all that other type of stuff. So you want to roll it over. Well, if you do it late, one of the mistakes is not taking your required minimum distributions prior to doing that rollover, and so it's a pretty stiff penalty for not taking your required minimum distribution. And that's basically what the IRS is saying is, okay, well, you've had this tax money, or you've had this money long enough without having taxes paid on it. Now you're required to do some type of withdrawal. But that penalty is pretty much double what your withdrawal value would be that if you don't take it. So, not only do you need to make sure that, you're claiming the funds and making sure they're invested appropriately, but then you've got to start looking at, okay, well, am I withdrawing those funds on the regulated basis in order to do that? So it's a lot to keep track of there.
Yeah, one of the things that I don't really like about that particular penalty is it is a not paying attention penalty. That's really what it is. I mean, if you take a look at those RMD distributions, especially from those retirement plans, right? And there have been instances that I have seen where even financial advisors will fall prey to this, where maybe they will pull the money over without actually doing that RMD distribution before it comes out of the retirement plan. If you look at the way the RMD distributions are calculated at the basically how the IRS views it. You have one IRA, okay? So I don't care how many individual retirement accounts or IRA accounts that you have out there. Now I'm talking traditional IRAs, right? The ones that are actually triggering the RMDs. You could have 17 of them, and they calculate the RMD based off of the aggregate value of all of those different accounts. That is not true when it comes over to retirement plans like 401ks, 403bs, and other arrangements. The RMD is calculated for each one of those plan accounts. So if you have two 401k accounts, you have two 401k accounts that each require their own separate RMD distribution. The aggregate rules do not apply to those retirement plans. And that is one area where I've seen some instances where people have gotten tripped up on that because they said, well, I took a distribution from my 401k plan thinking that it's similar to IRAs where maybe they had a $5,000 and a $5,000 RMD, but they pull $10,000 out of one plan thinking they're done. Nope. You only
Right.
satisfied the RMD off of that other page. Now we're getting hit with excise tax off that other 401k for not taking the RMD, even though you took the overall amount that you were supposed to
Right.
if it was underneath that aggregation rule. So that is another thing kind of along there, making sure that when you're looking at trying to move some of those assets and trying to do some of that consolidation to maybe make life a little bit easier, make sure that those RMDs are taken from that plan if you are subject to the RMD rules or the times at that point.
Exactly. Yeah. Yeah. In terms of rollovers, with that in mind too, one of the things, and we probably don't see it as common as what we do other things, but if you do have after tax dollars in your IRA or your 401k, making sure that you don't roll that money into the IRA, because it could be more tax advantageous to you to make sure that, okay, well, maybe that can be rolled into a Roth IRA because you've already paid the taxes on that money, versus having already paid the tax and then having that money subject to tax again if it's under the IRA platform. So.
Yeah, this particular one is one that I think does hang people up not infrequently. And really, this particular mistake is talking about the rollover rules are relatively complicated. But one of them basically says that you can't take Roth money from one employer plan and put it into another one. So you could take the Roth money from that 401k and put it into a Roth IRA, but you can't move it from company to company. And that is something that, because you can still do it with the pre-tax money, I have gotten some looks before when I kind of am trying to explain this to somebody. It's like, look, I understand that you want to do this and you want to consolidate down, have one account or one 401k or one administrator that you're dealing with, and you're just trying to simplify your life. It is not possible to do this because you have this sleeve of Roth dollars. So either your options are to leave it over there, pull the money out into your pocket, which again, we don't generally recommend if it's a retirement asset and it's being dedicated specifically for that. Leave it there, take it out, and in that particular instance, you cannot move it over to that other 401k arrangement at that point. So, there is some hiccups on that side that can create some challenges for and again, this isn't necessarily just for average, ordinary, every people, but this is something that I've seen in some industry things that people have fallen prey to this, where they've inadvertently call it, well, why won't you take that Roth? Like, what's going on that? It's because the employer cannot. They're actually prohibited from actually accepting those contributions.
Well, and I would think, Casey, that's one of the causes for some of the mistakes on other things. So, if you have to leave your Roth money with a previous employer, but it's out of sight, out of mind, can it be part of the cause of, that unclaimed property, or, just losing track of your old 401k dollars?
It's almost like this stuff doesn't exist in a vacuum.
So I'm curious to, see your thoughts of the advantages and disadvantages of leaving that in the 401k or rolling it into a Roth IRA of your own, which is still allowable, right?
Yeah, you can still do that rollover. Again, I think there's some different considerations that goes into that. Again, one of the challenges that you do run into, even with this Roth to Roth, so the Roth 401k to the Roth IRA rollover, it's still a cash transaction at that point in time. So again, leaving the money in cash maybe is not the most advantageous. I do think that there can certainly be some administrative efficiencies. Right. If I have a situation where I've got 4 different job changes that occur, and I have a 401k in at each one of these different jobs, and I have a Roth portion on there, maybe looking at it and just saying, administratively getting this down to one account does make a lot of sense in order to open up that Roth IRA and get all the accounts over off that side, because now I'm dealing with 2 different companies, maybe my existing 401k provider and that Roth IRA provider, rather than having to deal with all the various different companies that are there as well. The investment selection is obviously something I think is really important as well. I've seen 401ks that are absolutely phenomenal. You look at some of those 401ks, I mean, they effectively, not quite, but for all intents and purposes, they almost look like a traditional IRA arrangement just because of some of the features that they have embedded within the actual 401k plan itself. I've also seen some that, quite frankly, unless that individual was getting a match, I'd say, why would you put money into this thing? Because the investments are extremely expensive, to the tune of 4 and 5 times X what other ones are, and this employer really is just asking for a lawsuit for fees.
Yeah.
But yeah, it just definitely is. It definitely, I think, is a consideration that does merit a conversation. And at the end of the day, our job is to make sure that clients understand, here's what the different options are. Here's the advantages and the disadvantages of all these various different things that you can do. And let's help you select the option that you want to do and that is the most appropriate for you.
Right. Okay. So what do you think about loans?
Yeah, so the 401k loans. 401k loans they're an interesting one. I'm not the biggest fan of 401k loans, especially for participants. And primarily this comes over to the deemed distribution rule, where if you lose your job, you have to pay that loan back within, I think it's 60 days or something like that, isn't it?
Mm-hmm.
But yeah, and so with that deemed distribution or the deemed distribution rule, if you do not replace that, if you're no longer employed at that employer, it can create an additional tax burden on top of on top of what you were doing there. Now, the other part of that is, generally speaking, most loans are non-transferable. Mm-hmm. Right. So let's say that I'm moving from one employer over to another. I can't just transfer my loan generally from one employer over to the other. I have to replace that loan with money out of pocket, which, let's be real, why'd you take the loan in the first place? Probably because you didn't have money in the pocket, right?
Right.
And then transfer it over and then retake that loan out. Otherwise, I'm going to get tagged with a distribution, on those particular funds. So, I would say in the vast, vast, vast majority of circumstances, I am not the biggest fan of loan arrangements inside of 401ks.
I have to totally agree with that, just because, not only, is that loan payable when you leave employment, but I think you're also, losing out on opportunity cost with the investment. And, I think segmenting, your loan and purchasing with your retirement is probably just a bad idea in general.
Mm-hmm. Well, yeah. I mean, you mentioned the opportunity cost, right? Because let's just say, just use some rough numbers from a like a 10% loan, or excuse me, a $10,000 loan. So, you pull, you have an account value. Now you can only borrow a max up to 50% of the account value, or up to $50,000 a year. Okay, right. with the loans. Now, the one thing I will say that is maybe an advantage on the loans compared to maybe other financing options is that you don't necessarily lose that interest. So typically you'd look at like a prime plus 1 or prime plus 2. That's the most often on the loan provisions that I see. That does get credited back into your account. Right. So that is a positive, rather than necessarily having it go somewhere else. Over to an institution, right? So rather than paying interest to the bank, at least it's going back over to the account.
Right.
But exactly to your point on that opportunity cost, if we had a $20,000 account that we then took down to $10,000 because you took out that loan, and then over the next 5-year period of time, you pay off that loan to get yourself back up to that $20,000. You just missed out on all the gains that $10,000 would have made over that 5-year time frame. Okay. And that's exactly from an opportunity cost that you're talking about, especially if we're making that comparison against, various different financing options, if it's appropriate. Right. Take, for example, a home mortgage or something like that. Generally, the cost of finance that is going to be less than if I go through and I actually do it from an opportunity cost standpoint and make that over a 30-year time frame on that 401k loan. So, right. Yeah, it's definitely one of those. The opportunity cost that you mentioned on that is a huge piece that I think that most people, they're just looking at it from a, how do I get my hands on some fast cash? And this is that big account or that big amount of dollars that I have available. So they're not necessarily considering that opportunity cost that actually can come into effect.
Yeah, because I think most people are saying, okay, well, I'm going to pay interest on this loan, but I'm paying myself interest on this loan. And
and I think that can be the trap, and which is fine right up until the point of time that you get fired. Yeah. So, kind of along with that, we've definitely been hitting on a lot on the 401ks. So kind of moving over to 401k millionaire status, right? Mm-hmm. So when we say, somebody's a 401k millionaire, it means that they've got more than $1 million inside of their 401k or inside of their retirement plans. Recent data from Fidelity shows that we have seen a significant increase in 401k millionaires. The average balance in these accounts has hit just shy of $1.6 million, which is that's awesome. Mm-hmm. Right now, average is average, right? So, I mean, you could maybe make an argument that, some of the data is skewed by, ultra high net worth or something like that. We saw that ProPublica data that came out, and Peter Thiel, that guy's my hero. He's got more than $1 billion in a Roth IRA. I want to have $1 billion in a Roth IRA one of these days. I bet Elizabeth Warren would probably get a little upset because she did that last time. Anyway. What's interesting on this is that in 2022 we have in the U.S. about 16 million millionaires actually that are floating out there, whereas compared in 2019 there was about 9.8 million millionaires. We've actually seen a pretty significant increase in the number of people that have really achieved this status. And if you take a look at, additionally, of those people, about 90% own stocks in some way, shape, or form, either directly held stocks or indirectly through a retirement account or something like that. But about 90% of them own stocks, and then about 87% of them own their own personal home. I mean, these are just kind of incredible things. So, what is it the things that actually takes to attain that status and then keep that status? Well, most of these individuals, they live below their means, right? So if you take a look at The Millionaire Next Door, so that's a book that they published back in, I don't remember when the original copy of that was. It's been a while since I read that
over
one.
20 years ago.
I think I read it when I was donating plasma in college, which it's a fantastic read, and they actually do update that data, periodically. But one of the habits they talk about underneath a lot of that, and it actually emulates a lot of the the millionaire status. They live below means, right? So I mean, if you're making $100,000 a year and you're only spending $85,000, we've got another $15,000 there that you can actually save and put aside in order to prepare for the future, right? Or maybe you're making 50, but you're only living on 45 or 40, or maybe you're making $3 million a year, but you're only living on 2, right? In any one of these circumstances, really that living below the means is a significant habit. So not taking out a lot of that extremely expensive forms of debt, such as credit cards and other consumer debt on there as well. That second habit that we see actually happening at that point is individuals really focusing on their time and energy into those wealth building activities. So really segmenting that time and making sure that they are focusing on the things that actually give them a lot of return. So I'm just out of curiosity. So when somebody says that to you, focusing on wealth building activities, what does that mean? As far as you're concerned, Scott. I mean, what kind of pops up to mind? For you.
I mean, I think just investing. I mean, you live below. I can't even speak today. Live below your means, but then also the catchphrase is, it's not how much you make, it's how much you keep.
Right.
And so investing, whether that's in a business or whether it's in stocks or mutual funds, big difference there is individual stocks. A lot of us can't even buy certain shares of some companies if we're looking at our monthly balance, where a mutual fund allows us to invest in multiple companies in that route to do that. So I think the diversification in wealth building is a little bit different in that regard. The wealth building, I think, is more diversified investing, where if you just say I'm investing, that might be speculative in some cases.
Sure.
So.
Yeah, what's interesting on something that, and I'd kind of agree with the general track that you were taking there, that if we look at some of that wealth building activity, it might not necessarily, it can be working within a business or focusing on revenue generating activity. But, a lot of people that we do see that have really hit this status, they're not necessarily business owners. Maybe they're a teacher, or maybe they are some sort of like a public servant or something like that. But it's not necessarily people that are just making buku bucks. But these are people who have been very consistent in their savings, right? So, wealth building activities might be a little bit different person to person, but and for some people, it might simply mean still maintaining that living below your means, but then taking that excess or putting together some sort of an automated plan in order to make sure that you are, really, really focusing on the things that are really important. I would actually argue that, like you take a look at our family right now, like, my wife stays home. Now, I have told everybody this multiple times. My wife works harder than I do. If you want to take a look from our standpoint, the primary wealth building activities that she handles the house. And she does it a lot better than what I could, on any day of the week. But that allows us really to kind of segment out those various different responsibilities to where, as a family and as an economic unit, we can really help to amplify each other's efforts when it comes over to, focusing on a lot of these things. And I know that's not true for everybody, just our individual situation. Other people that I know, both spouses work, in those particular instances. And then I know some people that, maybe it's I know a single guy that he has a cleaner that comes in 3 times a week, right? And because his entire rationale on that was, I can go spend my time doing other things rather than doing the dishes and doing the laundry. I can hire that out at $20 an hour versus me going in and focusing on things that bring in. It's an attorney, so $300 an hour in that particular instance. Yeah. And so really, it's kind of this: a lot of times with these millionaires and these emerging millionaires that we see this how can I figure out a way in order to maximize the value of my time and then try and offload some of those tasks that I don't necessarily have to handle on a day-to-day basis.
Yeah, that's a catch-22 because I've heard a lot of times okay, well, you should delegate, figure out your hourly salary, and then delegate the rest of it that is under that. But then there's a fine line to where are you delegating everything, and then are you using your time to earn whatever hourly wage that you've set for yourself,
right? Yeah. And it's are you actually replacing it with that revenue generating activity, or are you just sitting on Xbox? Because
exactly, yeah.
There's a little bit of a difference between those two things, I guess, unless you're like some big YouTuber that exists out these days, and so every time they do that, maybe I don't know, maybe that works for them.
Yeah, and I've been totally guilty of that because I live in a townhouse and we have an association, so they take care of the lawn. I can't go out and buy a lawnmower and gas and all that other type of stuff and do that. But do I really use that time that I would have taken to mow the lawn to generate additional revenue? A lot of times I get home and I say, oh, the lawn was mowed. I got free time. Yeah. So I mean, it's a happy medium to
but again,
to look at
I
that.
think that to your point, there definitely does need to be some balance on that too, right? I think that if you look over on there from somebody who is again more well balanced, maybe you get yourself to a position where you can offload some of that stuff because you're actually capturing some of your time. I would actually argue some of the times that for me are the most incredible is the time that I get spent with my kids. I love doing that. Now, I haven't figured out a way to monetize that, and if you want to really get down to it, it costs me a lot more every time. Depending on what it is that we're doing. But I mean, those are times where I would not trade that for the world. But that's because I look at that as I'm investing over in those relationships with my family, rather than trying to build out, just a purely monetary value. Now, I think that also brings back an interesting concept. One of the things that we talk about, even from a podcast title, we call it Wealth Without Barriers.
Mm-hmm.
Well, what does wealth mean? I mean, that's going to be a little bit different to any individual. All individuals are going to be a little bit different on that. I am not convinced that wealth is only a dollar amount inside of a bank account. I don't believe that at all. When I look at somebody who is what I would consider some of our most successful clients, they are not the ones that have the most money.
Mm-hmm.
They are the people who are engaging in activities and engaging with other people and that are living extremely, don't misunderstand me, they're comfortable, but they are living extremely high quality lives in their interactions that they have with other people that are around them. And those are some of the things that I look at that, where it's not necessarily just tied to, when we talk about wealth, it's not just necessarily tied to a number that's inside of a bank account or inside of an investment account. Is that stuff important? Certainly it can. But insofar as it allows you to be able to engage over in some of those other things that allow that higher quality of life is really what I think that, exactly to your point, we need to also maintain that sense of balance and that sense of focus.
Yeah. And I think the high quality of life, I mean, even, whether it's your relationships that you hold or, even health. I mean, I've run across a lot of people that, they spend all their time, in their business, working themselves to death, and then they have poor health as a result.
Yes.
And is that truly wealthy? Maybe they built millions of dollars worth of business assets and stuff like that, but did they truly have a lot of quality with it?
Yeah, when you're on your 17th marriage and that kind of a thing, maybe there's a problem, right? And maybe that problem is in the mirror. Kind of this third habit on there. Individuals seeking independence and financial freedom rather than status. And this again goes over, I think, ties in very well with living below the means. Maybe not necessarily living in the biggest house or having the flashiest car or any of those kinds of things, but really kind of focusing on those things that we just talked about, right? Trying to focus on that sense of financial freedom that really can come of knowing that I'm in a good spot financially where I'm not going to have complete and total upheaval when we have Armageddon happen on November, whatever date is the presidential election, this kind of thing. I can tell you that I don't care who wins. Half the people in the country are going to be mad, right? So
True. Yeah.
I don't, it's kind of one of these things that happens every 4 years, and that's happened. So I don't know why this time would be any different. But what we want to make sure that, especially from this seeking independence and financial freedom, really is more about trying to make sure that, again, those things that we talked about, having that balance that you can really focus on the things that you want to do rather than having to be tied into anything.
Exactly.
Number 4, I thought this was kind of interesting, raising independent children. And where the stat stuck out over to me, if we take a look at people who have reported themselves to be unhappy, there is 4 times more likelihood that those individuals are spending more than $2,000 a month on their adult children. That is staggering.
It is very.
So, I mean, we're talking $24,000 a year going to support adult children. And as a result, these people are, I would probably argue, rightfully so, saying that they themselves are miserable. So that is that's pretty incredible there. And then the final habit, working hard, right? So, don't misunderstand me. I think, again, that we do need to maintain that overall balance that we talked about. But, when it's time to work, it's time to work. When it's time to play, it's time to play. So work hard, play hard, and making sure that focusing on those things really is the final habit that was mentioned inside that Forbes article.
Well, first thing I want to do is mention, kids, if you're listening, it's not going to happen. The $2,000 a month.
Oh, yeah.
But and I want to touch a little bit because, some of the topics that I've got listed in front of me is, the raising independently financially independent children. Is some of those habits that do, and one of the things that points out to me, and it's kind of a fun little story. I'm a nerd a little bit on occasion,
a little bit,
and I found an app that was a list. You could do grocery lists and all that other type of stuff.
Okay.
And so when my kids started being able to drive and stuff like that, I was like, hey, we can download this app and you guys can tell me what we need to get at the grocery store. And,
is it like a shared list
type
thing? Gotcha.
Yeah.
Okay.
And you could put it together. And, one of the topics is the millionaires out there, 85% of them, make lists or something to that effect. And, whether they make a list and always stick to it, like at the grocery store, or if they make a list and somewhat stick to it, it makes a difference, and it's the habits. But, obviously it wasn't ever implemented because my kids made fun of me for it. And they said, Dad, you're the only one that likes this app. But I did like the app because, if you go to the grocery store, you know what you need. You're going to delineate from it sometimes, but for the most part, I tell you what, if I go to the grocery store without a list versus with a list, I'm going to spend a lot more on stuff that I don't need or don't want.
Yep.
So
it's funny you talk about the list, because every once in a while I will get a grocery list from my wife before she asks me the question that she was going to ask me, because she needs to clear out the grocery list in order to ask me the question, because she keeps the running thing in a text thread
I see,
to
yeah.
me. So I have accidentally texted some friends our grocery list as well, because I just had that one open, was putting things in there. So
Okay.
no, lists are awesome.
Yeah.
Do you want to do a transition to the next topic?
Well, yeah, and the funny thing is I was gonna start interrupting you because there's a couple of times here that I was like,
yeah, go for it.
So I'll just okay. Yeah. So Casey, one of the things I kind of want to go back to, becoming a wealthy person, and some of the things that we look at is 15% of the millionaires were in senior leadership roles, but then some of the other occupations where we have millionaires, and the one that really stood out to me, and not because I am surprised that they're millionaires, but I don't think I've ever heard someone say that teachers make a lot of money. Well, and they're number 3 on the millionaire list.
Yep.
And part of that is because they have learned to live within their means. They're probably good savers. They're good students as far as potentially researching. Okay, well, what are some good ways to save for retirement and be wealthy and all that other type of stuff. But if you look at this list. I know engineers, they make pretty good money, but I also don't necessarily, we don't, well, I mean, it's far-fetched that, you say, oh, well, all engineers are billionaires, and, accountants, management, people in management and attorneys. So again, it kind of goes back to, being that systematic investor, being consistent over time to do that, because the time, of the time in the market versus time in the market is, so much better, as an end result with things, because quite frankly, there isn't anybody on this planet that can predict what the markets are going to do 100% of the time.
Yep, that is absolutely. It is kind of fascinating, at least over as far as the list that you're talking about, the teachers do rank so high on there, right? Which I think is kind of a little bit interesting, just in terms of like the history of Premier. Way back in the day, when Jeff and Brock were really getting started, that was actually their focus market, right? They actually went around and did a whole bunch of the IPERS seminars talking to various different people, and it's really kind of expanded over into the business that serves a lot of different professions, even at this point in time now, as far as individuals and families and organizations. But yeah, no, it is kind of fascinating that teachers, in terms of the ranking and the number of people that are actually on that list as far as attaining that 401k millionaire status. Now, again, oftentimes when you look at most teachers as the public employees, it's going to be a 403b account as far as the variable investing. It is one of the professions that we do still see out there that oftentimes has pension benefits in one way, shape, or form that are available as well. But it has really kind of created this interesting scenario where they have been able to be very successful in terms of being able to accumulate and build wealth over time. And again, I think to your point, that consistency, right? It's not because the teachers are making so much more money than everybody else. It's that consistency principle that has really allowed a lot of them to be very successful, in the aggregate.
Right. And, on that, I think it's still a matter of, living within your means because, one of the statistics that kind of stood out to me is 94% of people studied said that they live on less than they make, but nearly 3/4 of all millionaires have never carried a credit card balance.
Yeah. That's incredible.
That's staggering,
Oh, well, I guess we just lost our Visa sponsorship, didn't we?
Yeah, we did.
Oh, yeah, no, that is absolutely incredible. But, again, I think you look over on that, even from a discipline standpoint, the carrying over on the credit card balance. I mean, you want to talk about financial suicide. I mean, it is one of those things that can significantly put somebody into a very, very poor situation, right? And this is carrying that balance on a month-to-month basis. I mean, we're seeing interest rates that are, again, in that 22 to 28% range currently that are being carried on a lot of these credit card balances. I know they get a lot of people signed up on college campuses, especially that first week. I remember seeing that happen all the time. It is a trap. Do not get the T-shirt. It is a trap. But yeah, credit card. The people who have really figured out a way in order to save have again live underneath their means and are not carrying those balances on a month-to-month basis because they recognize that is a millstone that hangs around your neck and will completely and totally drag you down and really rob you of the ability to create additional wealth into the future. Like, you're creating wealth, it's just not for you.
No, it's for the bank carrying their credit card.
Exactly.
So.
Are you done? You want to wrap up?
I think so, because I kind of touched on a lot of stuff.
I like it. All right. Yeah. So with that, I mean, these 401k accounts, these retirement plans, and again, retirement plans in general, they can be awesome, incredible vehicles while you're working. If you're looking for any help with your 401k, I know, Scott, you do some consultation on these things of taking a look at it, making sure that it is invested properly, helping people to do the things correctly, moving it from one plan over to the other. So feel free to reach out to us. You can contact us at 1-800-383-6590. Just let Linda know you want to talk to Scott or Casey. And then also you can go to www.premieriwm.com and you can also schedule another appointment on there as well. So with that, we do offer a free initial consultation. You can either follow the link inside the description or feel free to email us at contact@premieriwm.com and we will get that on the calendar for you as well. So follow Wealth Without Barriers for additional content, and we really appreciate you being here, and we look forward to speaking with you again next week.
All right. Thank you.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.